Hey everyone, my name is Gary Gaines. I'm an admin at Filthy Rich Futures. You're here because you're either considering purchasing a premium subscription or you've just joined the fun in premium on our futures trading Discord server. Thank you for watching this, by the way. You're on a good path. In the next few minutes, we'll cover some basic concepts that you have to understand to successfully trade with us. If you don't listen, and listen very well, you'll end up just like some of our members that had absolutely no idea what they were doing and got absolutely wrecked. I've had one person contact us saying they lost 3.2 thousand US in a few days. Another lost 900 in a single day. Another lost 700 in a single day. You know why this happened? Because none of them had any idea what a stop loss is, what risk management was, even what TradingView was. And hey, if you have no idea what these words mean, you're now in the right place. This will be a starting point to understanding these concepts. Our motto here is to keep you happy and well profited, day in, day out. The only way you and I can make this happen is for you to pay attention for the remainder of the series. I'll start with an analogy for you. Let's compare crypto and futures trading to driving a car. If you're completely new to this, and you've never traded anything in your life, imagine you're 16 years old and you don't have a license to drive a car. But you decide you'll start trading futures and jump right in with $1,000 and go balls to the wall with 100 times leverage. You've effectively just sat into a Formula One car. No idea what leverage is, what liquidation is, what a stop loss is, and a Formula One car is really, really fast. Without proper knowledge, you have no brakes. You have no steering wheel, just a gas pedal, and let me say that again, a Formula One car is insanely fast. Maybe you've traded some spot before, and you basically drive a Volvo. Sitting in a Formula One car is still scary, but at least you know a few things about driving that'll prevent you from dying. You know how to set a stop loss and brake when the F1 car is going way too fast. See what I'm saying? The most important lesson I can give you in this business is only investing/trading what you can afford to lose. When you deposit the money onto an exchange, consider that money lost. It's just numbers on a screen. You need to detach yourself from loving that money, from fearing loss. Yeah, it sucks when we lose, but it rocks 10 times more when we make bank. And at Filthy Rich, we make bank every day. Don't be a statistic. Don't be the 90% of people who lose their portfolio and quit. When our man Sniper gives us a signal, it looks like this. This is Sniper's crypto long Bitcoin USDT signal. Over here we have the same information as we do in the Filthy Rich signals, but structured a bit differently. So it says long Bitcoin USDT, our entry, our stop loss, our take profit, and Sniper's comment. In this case, he says use 125 leverage, opening 2 positions since stop loss is tight. High leverage, so make sure to manage your risk accordingly. So in this case, we get the same sort of information. But one thing I have to stress is even if the comment says 125x leverage, 50x leverage, whatever, use what you are comfortable using. If you are new, if you are a beginner trader, use 2x, use 3x, 5x, maximum 10x. These signals are scalps. They move very, very fast. And if you don't open the trade in the specified amount of time, then you will only make a losing trade. These signals are valid sometimes for 30 seconds after they post. They are highly successful, but they are hard to trade. That is why they are in the free section of Filthy Rich Futures. After Sniper opens his trade, you can see that he makes updates. In this case, he said, oh, by the way, I forgot to tell you, this was a limit order. Update. I'm like this close to entering all my limit orders at market. Update. For all you who entered market, that's like 80% of you guys, trim some profits here at nearly 100% profit. Update. Limit filled, trim some profits for 50% profit. And so on, right? So you can see that as the trade is going on, he will update you on when to get out of the trade. So at least that's easier to handle. So now that we know these things, let me explain another factor that will decide if you're a loser who lost 90% of his portfolio in a day or an absolute beast who made 5,000% in a month at Filthy Rich Premium. It's controlling your emotions. When you miss out on a signal because you were too late to enter the numbers and submit your order, don't let the fear of missing out take over your logic and reasoning. Chances are the market will turn against you right when you enter, and then you'll lose your money. When you make a bad trade and lose money, don't let the fury of losing take over and cloud your judgment, leading you to make half-assed decisions and end up losing even more money. Another signal is coming. Wait it out, grab something to eat or drink, relax, and know that you'll make it back. You should also know that as responsible traders, we only enter trades that have a solid risk-to-reward ratio. To put this simply, we don't risk $10 to make $5. That's a bad risk-to-reward ratio. A better ratio is risking $10 to make $20 or $30. A stop loss is an order that you place on your exchange to buy or sell your futures contracts when it reaches a certain price. Stop losses are designed to limit your loss on your position if the price moves against you. With a stop loss, you basically protect your profits by limiting your loss. So I know that the best way to show you guys this is to just use TradingView, and let's imagine right now for a moment that we're about to go into a position, right? Let's say we're about to go into a long position on Bitcoin USDT. Don't mind, this is a Bitcoin USD chart here, but basically what we want to do is we think because all of our TA just coincides, and we think the price is now going up. So we're about to place a long order right here. That's all cool and good. We might even be in profit for a few minutes, a few hours, but what if the price suddenly moves against us and Bitcoin dumps? How can I, the trader, protect myself from losing my investment, my money, or even get liquidated? Well, that's what we do with our stop loss. Let me show you guys a helpful tool that can help us visualize where our stop loss is. So there we go. We're going into a long position. I go over here into the leftmost part of TradingView and find the long position tool. I place it over here, and then I can decide, right? I can decide where my stop loss is and where my take profit is. So you have to do this within reason and logic, but basically we're placing our stop loss, let's say right about here. And this tool is very handy because it gives us the information about our risk to reward ratio. It's giving us very precise numbers, and it's saying we are standing to lose 13.5%. Our stop loss is going to be down here at 28,000, and our take profit is at 80.82%. That means that our effective risk to reward ratio is 6. We are standing to win 6 times more than we are standing to lose. Okay, so how do we set our stop loss? We open up our Binance account. Here we go. This is our Binance. And over here on the right panel, we have our price, the size of our position, and down here below, the take profit and stop loss. So when you see our analysts post information about a stop loss, this window right here is where we put that number. We input the number right up here. So to give us a bit of an example, let's just take Discord, and let's take, I don't know, maybe it was Kenny D that posted something about, there we go, we have a Luna long at entry at 7.819. So this entry is what we put into our price. Of course, we're going to have to find the correct pair to trade, and this is what we put into our price window. Okay, next. You see, he says leverage maximum or use 20 if you are new. Please, again, use only what you are comfortable trading. If you are new at this, use 2x, use 1x, use 3x, use 5x. 20x might be a lot for some people. For him, maybe even 100x is not enough. He also says do not wait for a signal for a stop loss. Only use 2 or 5% of your portfolio and don't be a hero. And then seconds after, he gives us our stop loss value. Our stop loss, we take this number, we copy it, we place it into our stop loss window. Our take profit is sometimes specified, sometimes not. Because he is always updating this position as the position goes. As you can see, 71%, 109%, there we go, 152%. He will give you the update saying, hey, close this position right now. We're well in profit, so close it now. So now that we know how to set your stop loss, what if Kenny D or what if Mini Musk says, we are going to now set our stop loss at break even? So for this, let me just do a quick explanation. Let's imagine that we have actually went, into this trade. We're now well in profit, and just, imagine that we have some great big candles right here and that we are well in profit. So we are, right here. We are profiting well. So what we can do to fully prevent us from going into the negative even a little bit is setting our stop loss really tight. So that means at break even. We can even choose to set our stop loss above our entry to cover our costs of opening the position, so our fees and commissions. Okay, so how do we do this on Binance? I don't have an open position right now, but I will show you and I will overlay an open position on Binance. Over here is a TPSL button for your position. You click this, and here is where you set your stop loss. So what is break even? For break even, you can set either your entry price, so the same number that you put into the price window for your limit order, or you can calculate using the Binance calculator how much you are paying for commission and increasing your stop loss above your entry to even cover your costs of opening that position. And I think, guys, that's it. I think that's as simple as I can make it. Why do we always open a stop loss? The price might not move so drastically on a daily chart, but what if we look on the 1 minute chart, right? The 1 minute chart, and if I move this out of the way, go way down, there we go. On a 1 minute chart, the price can be very chaotic and can move very, very fast, and it can eat you up if you do not have a stop loss. Sudden dumps in price, just like this one. Imagine we went long right over here. We make some profit, 1 candle, 2 candle. Oh, there we go, right? Yeah, this is okay. Yeah, okay. Imagine we held on through that red candle, shot up way strong, right? And then we just decide, well, we're well in profit. Now we're just going to set our stop loss at break even. And even this red candle couldn't hurt us at that point. When we are setting our stop loss at break even, we are effectively preventing ourselves from losing any money. So that trade is completely safe. Remember, trading is a lot about mitigating risk and managing your risk. This is a very important concept that you must understand. You must always set your stop loss, protect your money, protect your position. So what is a leverage? Leverage is the ability for you to open a position that is worth way more than you have in your account. Leverage basically means that you as a trader need only commit a portion of the money to control your position. This means that if I have $1,000 in my account, I can effectively make positions 2, 5, 10, 50 times the amount of money that I have in my account. Now, you would say, well, that's good, right? Somebody's just going to lend me money and I can open a position with way more money than I actually have. Well, yes, that's true. You do get more power for more profits, but you do at the same time also get way more risk. So how do we count leverage? Well, first thing, before we go into, 5x, 10x, we need to understand isolated and cross margin mode in Binance Futures. Isolated margin is margin that's allocated to an individual position. So let's imagine I open a Luna USDT short with $100 and 10x. Effectively, I just opened a position worth $1,000. So I staked 1,000 US for this position. Now, isolated margin mode allows me to manage my risk on that individual position by restricting the amount of money, the amount of margin that I allocated to that position. I can individually adjust the margin balance or the amount of money I staked for that position across all of my open positions. So maybe I have one for Luna, maybe I have one for Ethereum. I can adjust margin for those as they are in play. What you need to understand, and the most important distinction between cross and isolated is that if you get liquidated, God forbid you forget to set your stop loss, in isolated margin mode, instead of your entire margin balance, only the isolated margin balance gets liquidated. So that means that only the money that you dedicated for that one position will be lost, not your entire margin in your account. So again, let's imagine I enter a long position in Bitcoin. I go at it with $1,000 and 10x leverage. Effectively, if I get liquidated, I won't lose more than $1,000. It doesn't matter how much I have in my account, other than the maintenance margin that I have to have in my account, but I will only lose what I dedicated to that one position. If you want to prevent yourself from being liquidated, and this is pretty much, you shouldn't follow this advice because you should always be setting a stop loss, but you can also prevent being liquidated by allocating additional margin to that position. The other margin mode is cross margin. In cross margin, the entire margin balance is shared across open positions to avoid liquidation. If cross margin is enabled, traders risk losing their entire margin balance along with any open position in the event of liquidation. But any realized P&L from another position can aid a losing position that is close to being liquidated. Typically, cross margin is the one that is set by default on Binance. And apparently Binance thinks it's more suitable for novice traders, but we don't think so. Isolated margin is way safer because you know how much you stand to lose, and margin is not shared between all those positions. So if we opened a new, let's just go with anything. Let's go with Algo USDT. We open this up. There we go. It is set to, apparently I've already traded that, but basically right here in the right upper corner is where we have our cross and isolated modes, and we can set from one to the other right in here. The next thing is we can adjust leverage right next to this by saying, I want to play with 1x leverage, I want to play with 2x leverage, 5, 10, 50, however much that trading pair supports. Below this, it'll tell you the maximum position at your current leverage is 5,000 USDT. It'll also give you a warning that your leverage is high, so please manage your risk accordingly. Okay, so I just set this at 20x, right? I press OK, I'm in isolated 20x, and let's say I want to open a limit order. I can set my size to, let's say, 25% of my portfolio. By the way, don't do this. Always use, what you can afford to lose. So 5%, 2%, however much. Let's imagine I put this at 25%. Because I am at 20x, I will effectively buy 5,136 algo, or if I want to sell it, I will sell 5,271 algo. But wait, so how is this possible? Well, I am at 20x. I have 954 USDT in my account. That times 20x, and 25% of my entire margin in my account is 5,225 algo. If I want to go to the max, let's say I want to, max this out. Oh, there you go, right? this is starting to make sense. This is 20,000 algo because I am at 20x. So on the Binance user interface, up here on the right, you can see there is a limit, market, stop limit, trailing stop, post only. So let's just cover limit and market, and let's mention stop limit and stop market because they can also be useful in our trading endeavors. So what is the difference between setting this to market or just setting it to limit? When you want to open a position, you have these two options. One, you can place the order at market, which means that the transaction will execute as quickly as possible, which usually in crypto futures is almost instantly since there is always supply or demand at the current market price. Or you can place an order at limit. Limit orders will set the maximum or minimum price at which you are willing to set the order. So just as a joke, if I want to FOMO in, I would FOMO in with the market button because I can just set my size. I can set this to, I don't know, 25%. Okay, so the slider doesn't work. Let's go over to ADA. Okay, I got my sliders working again. So if I want to FOMO in at the market, I would just put this to 25% and click open long or open short. There is no specification of any sort of price here. The only two prices I can set is my take profit and my stop loss. But at the limit order, I have one more window, and that is our price window. So here I can specify at what price I want my order to be filled. If there is no supply or demand at that particular level, at that very specific price, then my order just won't get filled and I won't enter a position. So effectively, my transaction won't occur. When to use one or the other? At Filthy Rich, we say use limit orders. I will put this stuff on screen right now, but here you can see the difference between a limit order and a market order when it comes to fees and commissions. You basically pay twice the fees and commissions for entering at market versus for entering at limit. That is why we always say use a limit order and specify your price at which you would like to enter your position, because you will save half of your money paying Binance their commission. And if you think that, oh, you know, that's 20 cents, that really doesn't matter. Okay, yeah, that might be 20 cents, but what if you're doing 50x leverage? What if you're doing 100 times leverage? Well, I'll tell you that if you do 100 times leverage, you'll be paying freaking skyrocketing fees and commissions. I sometimes pay up to $10 for just $100 of margin on 100x. That's pretty bad, right? That's $10 in commission that you're paying just to open that position. So it is important to use the limit order, because otherwise I would be paying $20 in commissions. Now, when to use a market order? You can use a market order when we don't have a nicely specified limit price to enter your position. That means if the signal specifically says use a market order, we'll go ahead and do that, because it might be a swing position. It might be a position that'll last, 3, 4, 6 hours. And it doesn't matter if you enter at 133.28 or at 133.48, right? It doesn't really matter, because the difference in price percentage is going to be so great that, ultimately it won't matter. Of course, we would still prefer you using a limit order. Binance recently added this last button over here that effectively, see, as I click it, my price changes. So if I'm quick enough, I set this to last, set this to, 5%, boom, open my position, and when my position is open, instantly go over to my position, set my take profit and my stop loss. Most importantly, stop loss, and there we go. So let's mention stop limit orders really quick. What is a stop limit order? That's the third type of order you can execute on Binance. A stop limit order is a type of stop loss order, but at the stop price, the order becomes a limit order. only executing at the limit price or better. The best way you can understand this is by us breaking it down to two different things. So as you can see, there is a stop price here and there is the normal limit price. The stop price is the price that triggers your limit order, and the limit price is a standard limit order. So what this means is once your stop price has been reached, your limit order will be immediately placed. So a stop limit order is basically a great way to cut your losses, to protect yourself from making more losses. And I should also mention, there are other types of orders. Let's be honest, trading is really hard. I've heard way more failure stories than success stories. The dreaded statistic that's going around is that 90% of day traders quit after losing all their money. The remaining 10% are the people that take their money because they're more educated, have better skills, tools, and experience. Our mission within the entire trading community is to help you not become part of that statistic. And what I said before about more experienced traders taking your money is true. When you enter a trade and you're making a loss, someone else's position is making profit. There's no deficit here. What one loses, someone else gains. If you made a really bad call, you paid for someone's lunch, or maybe their monthly car payment. You get the point. Motivation plays a key part in trading because, as I mentioned in the first part of this series, controlling your emotions is a huge part of staying in the game. Trading will beat you down. It beats down everyone. What matters at the end of the day is if you kept getting up and trying again, learning more, gaining experience, confirming strategies, talking to other traders. And during all this, you'll lose motivation. You'll think that you're not smart enough. You'll think, this isn't for me. You can't handle the stress. And look, yes, there's people who just simply can't handle day trading on the side, much less for their daily job. The 9-to-5 you once had will become watching the charts 24/7, losing yourself in the trend lines and Fibonacci levels, but you're probably not there yet. So, in this video, I'm going to explain the concept of 2% per day. 2% per day is something that the creator of Filthy Rich taught everyone that was in doubts, everyone that didn't think they could make it, and that doing this is not realistic. So to start, let's imagine you have $1,000 in your trading account. First day trading, you made 2% profit after fees. That's $20. Life is good, you're happy. The next day you do the same thing, but this time you start your day off with $1,020. So after you make your daily 2%, you now have $1,040. Cool, another $20. But then the third day rolls around, you wake up to trade, do a couple mixed trades, and at the end of your session, you've made 2%. And hey, your account is now at $1,061. Every day you start with more money since you made consistent 2% profits every day. Now, look at this projection. We've put this theory into an Excel sheet. We started with $1,000 and we made 2% that day. We started off the next day with $20 more in our trading account and we made 2% that day. And as time grew on, we had more and more money in our trading account. So after 365 days, can someone guess how much that is? Let's see how much that is. We're almost there. After 365 days, so 1 year, you would have been a freaking millionaire. This notion that I've described is called compounding. You started off every day with more money, meaning 2% of your daily starter was more on the 10th day than on the first day. Of course, you won't just have winning days. You'll inevitably have a bad trading day and end up losing 2%, maybe even 2 or 3 days in a row. And this projection will end up taking you longer. Controlling your emotions comes into play again. Limiting yourself to only lose 2% that day is key. Frustration and fear of missing out won't get you anywhere. It is not the winning strategy. Think about this a bit. partial closing or taking partial profits. Our premium members will know that our analysts ensure consistent profits using this technique quite frequently. I'll also mention the concept of runners at the end of this and explain what our analysts mean when they say leave some runners. So what I'm talking about, of course, if I just pull up Discord, and I can do this for any one of our analysts, but let's just stick to Minimusk at the moment. Minimusk gives us a signal saying this is a risky long for CVC, leverage 50x, entry at 0.23, and then he gives us moments later a close. You see, this was 1 minute and half of the trade was already being closed. And he said exit 1/2 of the position at 0.2324. So what did he mean when he says exit 1/2? Okay, so to explain this a bit better, some exchanges support partial closings, and I'll overlay this for Binance on top of this so you can see what I mean. So in Binance's case, when your position is open, you're going to see two windows, market and limit, and two windows next to it into which you can input the limit price at which you want to do your partial close. When you click the limit or market button, a few options will appear. So you will have the option to close 10%, 25%, 50%, 75%, or 100% of your position. What this basically does is it ensures the profits that have already been done on your position and leaves the other half to still run. So you're basically taking the margin out and realizing your profit or loss. Some exchanges, however, don't support this, and you will have to complicate things a bit more. Let's say we have $100 in our position, and just because of the price action of Bitcoin, let's say that we are in a long. So what we would do to exit half of our position would be to open half of our margin, but in the opposite direction. So in this case, if we wanted to take profits right here at 32,781, then what we would do is enter half of what we put into the long and press the opposite colored button. So if we opened a long, we now open a short. Effectively, what that does is take half of my margin off of the existing position because it already filled that order. I hope that explains this notion to your satisfaction. Now let's cover the concept of runners really quick, because, and this is what I was talking about, I think we can find some runners here, right? There you go. It says update CVC runners are still open. Stop loss is set at break even. TP1 is set to 0.25, TP2 is set to 0.256, and TP3 at 272. So leaving runners means essentially after getting out 90% of our margin from the position, we can still let a little bit of it run if we are in a greater trend, if we are in an external trend. Let's say right now we know that Bitcoin is rising, so we see this steady rise, and right here I would have already gone out of 75% of my position, and I could let 25 to run for a few hours, for a longer period of time, to catch the wave, to catch the trend, and in this case ensure some more passive profits, basically, because we've already made the bulk of the profits by scalping, but now we're just letting it run. And there is absolutely no risk by leaving some runners because we have set our stop loss to break even. And what that means is that even if the price would in this case suddenly dump, we would cover our costs of fee and everything would be dandy. We have a good trade and life is good, right? Now, one more thing that you have to consider is that yes, you will pay more fees every time you close your position partially. But that's pretty much the only downside. So guys, I hope this was understandable. Thank you so much for watching. Please watch the video again if anything was unclear. Contact us if anything was unclear. Don't forget to like and subscribe. And guys, stay frosty.